Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I am joined by my colleagues from across our ratings teams. We have broken our discussion on this podcast into two sections. This one, our second of the two Outlook podcasts, will focus on the commercial-oriented collateral within European securitisations. We will be covering the topic of our 2023 Outlook, which was published at the beginning of December. In the report, we discuss our views on the outlook for European securitization, where the extreme inflation of 2022 will continue to impact on collateral performance and issuance volumes in the European securitization markets in the year ahead. In particular, as central banks combat high inflation with interest rate hikes, a number of securitization sectors will contend with more difficult financing conditions. In addition, the deceleration in growth across Europe, coupled with 2023's widely expected recessionary conditions, should also weigh on performance. Sensitivity to energy prices and energy transition objectives will be key to performance. On the positive side, the market approaches these challenges from a position of strength, with supportive balance sheets from a corporate perspective, low unemployment, and positive economic growth in the quarters before. First, let me bring in my colleague from our Sovereign Ratings team, Ken Egan. Ken, let's start with the backdrop facing the European commercial market in the year ahead. Where do we see the inflation picture and the increased costs impacting on borrowers across Europe?
Thanks, Gordon. Yeah, inflation was a big theme for us heading into 2022. And the outlook for 2023 is much of the same, really, with price levels now significantly above target. Interest rates will likely go higher again next year, and the market is struggling a bit to come to terms with tighter policy from central banks. Refinancing costs are shifting higher, while liquidity conditions on European debt markets could deteriorate as central banks, which have been significant buyers, finally step away. I think crucially, the Russia-Ukraine war is unlikely to be resolved in the near term, and from an economic perspective, this keeps upward pressure on two important inflation channels, energy and food. From a commercial credit perspective, financial conditions are now much tighter. This appears more severe in the euro area than, say, the UK or the US, and could prompt changes in demand. Should capital spending and demand decrease, this would increase pressure on corporate incomes. Already facing elevated input prices as well as increased costs and availability of funding, companies could be pushed into making difficult choices, increasing the prospect of insolvencies and reduced spending. Maybe just to note that some corporates and households have improved their balance sheets in recent years, as you noted, and this can mitigate against the impact of higher rates. Ireland would be an example of this.
Thanks, Ken. With central banks looking to fight inflation by raising rates, what does this ultimately mean for borrowers in the euro area?
Yes, well, Europe's main source of inflation to date has been from the supply side, which dramatically increased energy costs, while central banks are targeting the demand side in order to stabilize inflation. So there is a bit of a mismatch for consumers and businesses alike. Interest rate hikes impact consumers and corporates with elevated borrowing costs. And while many have existing loan deals with low fixed rates, as these roll off, borrowers will face more expensive refinancing costs and in some cases, substantially higher rates. Moreover, as rates rise, property valuations decrease. This could likely impact commercial property markets as well as residential. The significant rate hikes by central banks worldwide will cool growth. And one area where increasing interest rates will have the most significant effect is on households and with regard to the cost of mortgage borrowing. Rates are expected to rise in the year ahead. This will have an impact on borrowers in terms of new lending, refinancing, and in some cases, outstanding borrowings. Forward rates for 1 month borrowing in 1 year ahead show that rates are expected to remain elevated in 2023. Forward rates for December 2023, 1 month borrowing indicates level of 2.6% in the euro area and 4.4% in the UK.
Great. Thank you very much, Ken. So with this environment, And backdrop, what does that mean for the European securitization markets? There are a number of elements that will influence European securitization markets from an issuance perspective in 2023. A funding mismatch, collateral performance, regulatory influences, and quantitative tightening. As the market adjusts to the rising rate environment, underlying collateral that had been originated previously at lower rates may be below the current cost of funds, thereby making the use of securitization of the lower rate collateral challenging. Collateral performance is likely to show signs of concern, which will increase investor scrutiny and as a result, place greater differentiation between sectors and transactions. Upcoming regulatory changes will affect the dynamics yet again for the viability of certain sectors. And further, as the European Central Bank increases the cost of funding for its refinancing operations, and as the maturities of elements such as the TLTRO program, there is the potential for this collateral to be used in publicly sold securitization transactions. KBRA expects that the coming year will see a dynamic market for European securitizations with an increase in public securitization sold to investors and a decrease in total securitization. This, of course, will depend upon market conditions, as investor demand will be key to ensuring the market can absorb the potential increased supply. In our view, newly circulated transaction volumes are estimated to increase to roughly around 130 billion, up from 73 billion in the first 9 months of 2022, and up from the 115 billion that was in 2021. However, total securitization volumes will decrease as the amount that has been retained, typically for refinancing operations, will decrease in the year ahead. Now, moving on into some of the specific collateral sectors, first, let's bring in my colleague, Stephen Hughes from the commercial mortgage-backed security team. Stephen, how has the current economic environment and outlook impacted the commercial real estate sector?
Hi, Gordon. I think there's no doubt that high inflation and rising interest rates have suppressed commercial real estate lending due to the reduced availability and increased cost of finance. CMBS new issuance will therefore inevitably be impacted by this, probably more so owing to the potential capital market volatility. So for the first half of 2023, we would expect muted CMBS issuance, although hopefully things will pick up as the year progresses and we get more clarity regarding central bank interest rate stances, and also just surrounding prevailing macroeconomic conditions. On the real estate side, we're seeing interest rates cutting into property yields. Currently, we have a phenomenon last seen just before the GFC, where 10-year gilts are above prime office yields in the UK. That subsequently led to yields rising by over 150 basis points. But it's not just a UK problem. In Germany, the property risk premium, so the difference between the property yields and the risk-free rate, that has eroded just 1% as well.
So what do these rate rises and the rate environment you just mentioned mean for CMBS transactions?
Well, modest property yield rises up to, let's say, 100 basis points could cause loan-to-value trigger breaches for some transactions. That could prompt cash trap or cash sweep mechanisms that could help deleverage the loan, partly mitigating value degradation. Loans structured with LTV covenants could be more susceptible to defaults if cap rates rose by 200 basis points or more. Such a rise would likely push a 60% LTV loan to over 80%, making it more difficult for a borrower to refinance, especially if there was any mezz debt on top of that. High interest rates may also prompt index rates to reach or exceed their caps for many loans. And remember to utilize pre-existing extension options, which are common in European single borrower CMBS loans. Borrowers must typically enter into hedging on commensurate terms. In some instances, strike rates may be below current reference rates, increasing the cost to extend interest rate hedges. However, we still think that by and large, borrowers will choose to exercise extensions where possible, as it should be more cost-effective than full refinancing.
Great, thank you. Now, what about sector-specific areas? How are these likely to be impacted?
The adage that commercial real estate is a natural inflation hedge will, I think, be tested in 2023, as landlords are increasingly exposed to rising costs. I think we'll see assets that require significant capital expenditure, such as shopping centres, older offices, or those with the renovation or redevelopment business plans. they could come under greater valuation pressure owing to higher material and labour costs. I think we'll see those assets that are let to high-quality tenants on long leases in which rents are annually adjusted to inflation. They'll command more of a premium, whereas those with high degrees of vacancy or those that are let to tenants on gross leases will be viewed less favourably, as landlords will have to bear a higher share of costs. Now, whether those increases can be pushed through to tenants by way of higher rents and service charges without harming occupancy remains to be seen. If I were to be a little more specific about the main property types, I would say for offices, although vacancy rates for office properties have been trending upwards since 2019, tenants reaching the end of their leases have been willing to sacrifice floor space for quality to entice workers back to the office. As such, newly constructed premises next to transport hubs that have the highest environmental certification, they'll fare better than older, more secondary offices, offsetting some of the impact from rising yields. For retail, I think retail assets will come under renewed pressure as a falling consumer confidence reduces discretionary spending at a time when inflation is eroding disposable incomes. In the industrial sector, urban logistics assets are expected to see continued rental growth in 2023. And that is because although internet sales as a proportion of total retail sales have dipped after the lifting of COVID restrictions, the long-term trend is still positive throughout Europe. The overall performance could, however, be hampered by a correction in cap rates, which got very low. They're breaching 3% in many key European markets. And finally, finishing on lodging and student housing, our main concern here is whether higher inflation could have a greater negative impact on the underlying cash flows of operational assets that are characterized by higher management, maintenance, and repair costs.
Great. Many thanks, Stephen. Turning our attention to the actual corporate collateral, companies themselves and potentially other types of company-connected collateral, I'll turn to my colleague, Killian Walsh, who covers our European ABS sector. Killian, corporates are going to be impacted by the environment that we are in. How do these feed into commercial-focused ABS transactions?
Thanks, Gordon. I suppose as a broad comment, first of all, I'd say that KBRA believes that commercial ABS fundamentals will come under increasing pressure next year. As you mentioned with Ken, economic growth slows, coupled with continued rate hikes, high energy prices, and declining consumer and business confidence in 2023. However, commercial ABS sector encompasses a large and diverse range of asset types. Whichever scenario ultimately materializes, some asset types will be affected more than others. The effects on small and medium enterprises are set to follow similar trends, we think, to those in the consumer sector, with the industry segments exposed directly to energy prices being most at risk. Businesses in the sector exposed to discretionary spending, for example, leisure and travel, may also experience a more challenging business environment. As underlying bank finance tends to subside for SMEs during recessionary periods, they are likely to struggle with required funding. However, from a securitisation perspective, this may lead to greater activity in the space, specifically securitisation space for SME lending, as non-bank lenders look to ABS as an alternative source of lending. Some of the other key issues facing SMEs are the ongoing developments in global trade finance, with supply-side challenges still evident. This is most notable with China's ongoing internal challenges currently, as the linkages to China trade finance will continue to challenge performance with delays in both shipment and consequently payments as per underlying contracts. Trends we are observing is recent amendments to the sanctions regime on Russian-related entities remain a very big challenge for industry since the outbreak of the war in Ukraine. Access to finance is becoming a limiting factor for many businesses in trade financing, as bank concerns over compliance and customer identification issues result in longer lead times for clients' approval and payment processing. Default levels are ultimately expected to be elevated in the near term for these markets, as challenges will likely persist in 2023.
Thank you very much, Killian. Turning our attention to one of the larger securitization markets, the CLO market, and the underlying collateral there are leveraged loans, who will likely be challenged in the year ahead, particularly those that have very elevated levels of leverage. Gabriele, how do you see things shaking out in European CLOs?
Thanks, Gordon. Yeah, in terms of the underlying credits, the rebound story for corporate credit portfolio seems to be in the rearview mirror as pressures from inflation and rising costs mount. The impact may be more acute for smaller companies on the lower end of the credit spectrum, with limited capacity to pay for rising interest costs from current cash flows. Strategic management at the portfolio level, coupled with the application of other lessons learned from the pandemic era, will likely contribute to a more prolonged and less severe credit drift for BSL portfolios over the cycle compared to the first semester of 2020. Individual corporate issuers and their loans will differ by capital structure, management teams, and the extent to which interest hedges are in place. These factors will probably differentiate performance within the same sector. Still, there are dynamics that make certain industries more vulnerable to cyclical forces or less able to pass through costs, which, as a result, weakens EBITDA margins. These will most likely be consumer-facing sectors with more discretionary demand, such as retail, apparel, leisure and entertainment, autos, and even specialty healthcare.
Thank you very much, Gabriele. So what about the issuance picture for European CLOs?
For issuance in 2023, we expect a relatively difficult year ahead, given the headwinds in the broader Eurozone economy and the loan market. Issuance volumes could be similar to the 22 billion recorded in 2020, when pandemic-driven economic fallout put the market on a much slower pace compared to prior years. We expect issuance to be within 20 billion and 25 billion in issuance for the year 2023, which is well below the 38 billion recorded in 2021, barring further major disruption from the ongoing conflict in Ukraine. De-escalation of military activity in the region would be a positive for the Eurozone from both a humanitarian and economic perspective, potentially creating rebound conditions and a more supportive borrowing environment.
Thank you very much for that. Thank you all for your comments. And thank you for listening to our outlook for 2023, where we see the extreme inflation of 2022 to continue to impact collateral performance and issuance volumes in the European securitization markets. In particular, as interest rates increase, a number of securitization sectors will contend with more difficult conditions, both from a collateral perspective and a financing perspective. And the recessionary conditions in Europe will likely also weigh on performance as we move through the year and into 2024. Sensitivity to energy prices and energy transition objectives will be key to performance. On the positive side, the market approaches these challenges from a position of strength, with positive balance sheets at the moment, low levels of unemployment, and positive growth in the quarters previously. KBRA expects that the market for European securitizations will develop according to market conditions, as investor demand will be key to ensuring the market can absorb any potential future supply. The situation changes by the day as governments, companies, and individuals adjust to developments in the markets. And we here at KBRA are actively monitoring the situation. Make sure you are registered on our website, kbra.com, to receive our latest commentaries. And of course, subscribe to our podcast and engage with our experienced analysts, as you have heard from today. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you as you navigate through a market that faces a number of challenges and opportunities in the year ahead.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.